actually have to hire your kids to do work that you're paying them for in order to get this tax break. Let me break it down into 3 simple parts for you, and even give you some ideas of what you could hire them for. 1, if you stand to the limit, they don't even have to file a tax return. This is normally what happens. You get to deduct their wages, and it will lower your tax bracket. The question really becomes, though, well, what would you hire them for? Did you know that you can cut your annual tax liability using the IRS's own tax codes? It's actually super easy. I saved $8,880 last year alone using this one simple yet effective technique. If you aren't using this technique, you're likely tipping the IRS, giving away your hard-earned money, and harming your legacy at the same time. See, I wasn't sure what to do. I had 2 opportunities to speak, but had limited bandwidth with my team. One event was called Baby Bathwater. The other was a dental convention in Boston. And they were within 24 hours of each other. So how would I get to both of these events? One on the west, one on the east. Well, my team would have to support the first event, and that would mean that they wouldn't really be able to attend the second one. Then I had this idea. Why not bring my kids? I mean, they can handle a red-eye flight. I'm not torturing my team. I got my kids doing this. They can sleep so easily on flights. We can even bond. They can carry books. They can pass them out. Maybe even introduce me on stage. Plus, they could earn money that would be, get this, tax-free. Yep, up to $12,000 tax-free. Even better, I'm the one on the account since they're minors, right? So I'm not just handing them money that they can blow. I can now allocate those dollars to building their own cash flow banking system, which is a way to put the money in pre-tax, have it grow tax deferred, and there's ways to access that money tax-free whether they go to college or not. So, I wouldn't have to pay the tax now or later. You could do this with a Roth IRA, but there are certain restrictions to that. But now the key to the strategy comes down to, first and foremost, integrity. You actually have to hire your kids to do work that you're paying them for in order to get this tax break. Let me break it down into 3 simple parts for you, and even give you some ideas of what you could hire them for. 1, if you stand to the limit, they don't even have to file a tax return. This is normally what happens. You get to deduct their wages, and it will lower your tax bracket. The question really becomes, though, well, what would you hire them for? I wish I would have thought of this when my kids were really young. I didn't know how to pay them at 2 years old, but later realized they could be paid for modeling. Now, not normal models for my business, right? So I get that's probably not worth $12,000, no matter how cute I think they are, but it can easily be worth $2,500. Put them up on a site, have pictures at the office. As they get older, then you can actually put them to work. That's what I did. I missed the opportunity to have them model, which is something that if you have young enough kids, you might be able to do. What I've had them do is MC events multiple times and even introduce me. I've had them go through online courses so they could start a business. I had a lot of clients on Amazon, selling things on Amazon. So I got a course when I spoke at one of these events, and I said, all right, let's have them work on this research, because one of my clients talks about retail arbitrage. I'm like, I wonder what that is. So it was about starting a business with my oldest son at that point. My youngest son, I started to write this book on money for kids. Well, I needed to have feedback and editing and stories. Does it make sense to someone that age? And he's actually really creative when it comes to writing. Those are just a few ideas. Now, I've seen other of my clients have their kids clean the office and wash company cars. That's actually how I started my first business, Garrett Gunderson's Car Care, when I was 15 years old. It was my dad being a coal miner. I started washing the surface mine vehicles with him and get paid for that. Or you might have them update a CRM or customer lists or different data entry, working in the computer, or it could even be billings and accounts receivable, which I've seen happen with a lot of my doctor clients, or general errands that they're doing. And if they're under 16, these are ones that they can obviously do without having to drive. Or maybe they're even handing out flyers for something that's coming up, or updating social media accounts, or keeping you current on social media trends. I know if I want to know what's going on there, I turn to my 12 and 14-year-old, they know a lot more than I do. So the second thing to really simplify this is employing your kids provides other benefits, like responsibility. Your kids can learn to take responsibility and get paid for it. So this can increase their self-esteem. They learn the value of a hard day's work. They get certain skills that they could build, so they have these abilities that they could put into life and actually make some money doing them. Brainstorming, you can even get them coming up with ideas from their minds of ways that they can earn money. We have our kids invoice us. A lot of times we'll sit down and brainstorm and we'll put it on lists of things that they might be able to do. What I think is even bigger is making sure they avoid entitlement. When they're working for their money, they understand the value of it. When it's just handed to them, well, they might not really recognize that. They could even learn entrepreneurship from a young age. Most of the greatest businessmen in the world were and are entrepreneurs and started a lot of times when they were really young. I would think of my friend Rich Christensen. He had all of his kids become entrepreneurs before they were 16 years old. Some of them were 3 years old and showing how to tie ties or do zip ties, because they had a tie selling company in business online. One of his kids now has his own business, and I actually hire them to do certain online things and building sites for us. So there's a real opportunity for them to start understanding upside potential isn't just trading time for dollars, just working menial tasks in exchange for some money. But if they start to think, what can they do that's of value in the world? And what is it that other people are looking for? I mean, we see young kids out there, opening gifts, and they're in their, they're not even double digits yet. They're 9 and younger, and they're making millions of dollars because of the amount of traffic that comes to their YouTube videos. I was in Puerto Rico speaking, and there was a guy that his daughter just wanted to start YouTube videos, and he started helping her when she was 11 years old. Now he's holding all the Lego conventions and Minecraft conventions, filling up entire stadiums for this because of that type of an idea. Whether it's big or whether it's small, I think the small actions make a difference, and you can do this tax-free. So you want to go to wealthfactory.com/hiring your children. Wealthfactory.com/hiring your children is going to give you 32 ideas on what you can do to hire your kids. It'll show you how to navigate the reasonable wage and what records are actually required, the nuances of pay based upon what type of corporation you are. The third piece to this is it's really about setting up a separate bank account for the money to be deposited. You don't want it to commingle with your funds and just have the money be spent. You don't want to go straight into the kid's piggy bank, or I paid my son Roman the other day and he forgot to take the cash and put it somewhere, so strangely half of the money's gone, right? It's a big lesson for him. It's only $20, but at that age, I remember losing $20 and it was devastating to me. Have the kids, you can have them start paying for their own music lessons or sports things they're doing, or even airfare or clothes, or if they're old enough, maybe gym memberships or cell phones. This way they can know what things actually cost. I was watching some thing that Ellen was doing one day, and she had Bill Gates on, and they were saying, how much do these things cost? And he didn't know what the price of milk was, and he didn't know what the price of some certain basic things are, because that's been delegated. Now, he's pretty wealthy, so it's not that important for him to know. But I think it's important for kids to know so they appreciate what they have and can acknowledge it and know that it actually costs. Now, you can use cashflowbanking.com to make this even more powerful. I mentioned before, some people use Roth IRA accounts. They pay their kids. That's giving them a tax deduction. They put it in a Roth IRA, and then they can take that out tax-free at 59.5%, depending on what the rules are, right? Well, you could do this with cash flow banking. That's my preference. That's what I do with my kids. I pay them monthly, actually twice a month because they're on payroll, and it goes into their cash flow banking systems, which means we didn't have to pay tax because of the tax deduction, paid to their tax rate, which is 0%, putting it into a plan that grows without taxes and that we can access before 59.5 if we want to help supplement, educational things, or the launch of a business, or the down payment on a home, or something where I'm matching what they're up to. This starts to create cash for them at a very early age. It's part of the Rockefeller method too, which is now they have a death benefit. That death benefit comes in tax-free when they die, and it could replenish the trust of which they could get benefits from as far as our own family bank that could lend money and have payback requirements. But we know that some of those loans aren't going to work out. There's going to be certain economic turmoil. There's going to be certain lessons along the way, but we can replenish those trusts. There's other videos you can watch where I've talked about this. So look, you can put money in a Roth, like I mentioned. You can put money in cash flow banking. It really depends on how much insurance the parent has on their life. So if you don't have any insurance, maybe you can't get that much insurance on your kids. If you have a lot of insurance, you might be able to get a lot more insurance on your kids. So it really begins to go into cashflowbanking.com for yourself. But here's the deal. You can pay your kids. You can get tax advantages for it. You can make sure to capture that wealth. You can teach your kids personal and financial responsibility with what they're doing. They can be part of the process of brainstorming of some of the activities that they could do. And we have guides at Wealth Factory that can help you to determine what you can pay your kids for. Now, you know how to cut your annual tax liability using the IRS's own tax codes. I saved $8,888 last year alone using this one simple yet effective technique. By using this technique of hiring your kids, you can save thousands of dollars on your taxes, teach your kids valuable life lessons they'll cherish for years to come, and guess what? You now have the knowledge to transform your thoughts into profits and build the life you love. Tax traps, the first two that you have to avoid. Number one, don't just defer taxes. So this means 401ks, IRAs, RSPs, Keoghs, thrift savings plan, I don't care, whatever it's called. If it's a government qualified plan that you put your money in pre-tax, you defer your tax to the future, you didn't save tax. Did you pay less tax the year you put it in? Yes, you did. But why did you pay less?
because you never took constructive receipt of the money. The plan took receipt of the money, and now the government owns the plan for your benefit. Who in here is excited to be in partnership with the government moving forward? I mean, imagine this. Imagine that you said, okay, the government's going to be my partner. They said they're only going to be a 40% partner today, but if I want to exit early, they're a 50% partner. And when I said, cool, that's fixed, right? They said, no, I'll tell you what my percentage is in the future, depending on what my economic circumstance is that you have no control over. That is your retirement plan. So if you put money in there and you don't know how you're going to get the money out, you're going to be pissed off when you find out you still have to pay taxes on it. So you didn't get tax savings in your pocket. Your tax savings are stuck in the plan, and it is a great big lie and hoax when they say you have $10,000 in there from a deposit. You don't have $10,000, you have $5,000. $5,000 is the government's money right now, unless you can find a way to offset that or avoid that penalty. It is a lack of disclosure, and it's problematic. Deferring tax does not save it, especially considering we're at a historically low tax bracket right now, not a historically high. Now, who plans on making more money in the future? Show of hands, right? When financial planners tell you you're going to be in a lower tax bracket, you should slap them in the face or at least give them a squirrel tap if you know what that is, you know? It's like, are you kidding me? Who wants to have less money in the future? I mean, especially if you plan on retiring. I don't really love this concept of retirement because the definition of retirement is to take out to pasture or to, die essentially. So that doesn't sound exciting to me. I'd rather have something I'm engaged in and then just enjoy life along the way so I don't just work myself to death for the one day someday when I have a replaced hip that I'm going to go out and enjoy life and be on the beach when I'm, so damn wrinkled no one cares. I mean, it's I don't love this notion of deferral for your entire thing. It's a crazy notion, and thinking you're going to have less money in the future is a nightmare. Because think about people in 1980, if you said, what's a good amount of money to have in a retirement plan, what do you think they said? Maybe $500,000, maybe $1 million if they were really thinking big. Now today, if someone told you, hey, you can never make more than $1 million the rest of your life total, who's scared? Immediately, yeah, that's not very much money, is it? By the way, I'm trying to see if I could speak faster than any other speaker. How am I doing so far? I just realized how fast I'm speaking. So, but you'll catch something. It's cool. I'm gonna take a break, let you process while I have a little drink here. So avoid deferral. The second thing to avoid, don't spend $1 to save 40 cents. It doesn't make sense. That's the tax tail wagging the dog. Had this guy, Gary, call me once, and he's like, he just started working with us in November. It's December. He says, hey, my accountant just told me congratulations. Which, by the way, that smug-ass accountant that says congratulations when you owe tax deserves to be tortured. They need to go to Gitmo. I feel like that's the only thing, because what the hell? Congratulations? You owe an extra $251,000 to the government. What a good year. Come on, that is horrible. That would just piss me off. And this guy was pissed, so he's like, what do I need to buy? And I'm like, well, what would you buy if you didn't have this tax bill? He goes, well, I wouldn't be buying anything. I'm like, great, then we're not going to buy anything. He's like, well, what about the taxes? I asked a few questions. I'm like, why is it such a big surprise that you have this money, that you made this money, and why are you finding out about it now? He goes, oh, I just had an event. We made an extra $500,000 than what we anticipated. It went so well. And I was like, cool, well, what did you sell? He said, well, coaching, and I'll be working with people throughout the year, this year, next year. I'm like, whoa, so you haven't actually performed, or they haven't rendered the services? He's like, no. I'm like, great, we'll move you to accrual. Now, everyone in the room shouldn't go to accrual. It is more complicated and expensive, but this person had a $251,000 problem that we were able to defer to the next year. And I know I said you never defer, but I'm deferring 1 year. And the rule is, if you have an exit strategy, you can defer. If you don't have an exit strategy, you can't. So I'm just deferring for 1 year. I moved $249,000, which gave us 12 more months to figure out the tax strategy, which we saved 100% of that, which I'll tell you how we did it in the rest of the stories here. So don't just spend to save, and don't just defer. So what do you do? Here's the 3 things to do. The first one, I think, will apply to nearly everyone other than a few of you geniuses out there that somehow are nerdy enough to figure this out on your own, all right? The first one is, if you're a business, by the way, if you're an LLC or an S-Corp, just so you know, if you ever get audited, you don't get the most premier auditors, you get the newest auditors. C corporations are reserved for the highest level auditors, just so you know. Just a little fun fact to keep in your back pocket. But what I find atrocious for business owners is most of them have a ton of expenses that could become deductions, and they don't take the deduction? First of all, because they have some yahoo that says they're an accountant that's not really a tax strategist. If you have an accountant that tells you they're conservative, what that's code for is they're missing tax deductions for you. That's just what it really means. Now, I don't believe you should do anything unethical or illegal, but I also don't think you should tip the government unnecessarily. So, if you have expenses that can relate to the business in any way, those are actually deductions. So, here's some examples. Siobhan came to my house recently because we had an event, and when it came over, we had 12 people, and it was right in the middle of the outdoor recreation show in Salt Lake City, which, by the way, it's really tough to get hotels or venue space. And so what I was able to do is charge a $7,500 charge to my business to rent my house to host this 12-person dinner. And that's tax deductible to the business, but as long as I do that less than 14 days in the year, it's tax-free to me. 14 days or less. So I just have a simple executive lease. I always make sure to have at least 14 functions throughout the year. And Google was going to film a commercial in my house, and they were going to pay me $2,500 an hour. So I told them hell no once we got the proposal, but now I have a proposal showing how much I can charge for my house. I really didn't want to have my house in a Google commercial, and then it's just kind of weird. So anyway, I don't even know that, just side note, just useless fact for all of you. So the second thing that I do to turn deductions or expenses into deductions is I have an intellectual property company because I write books and I do all this kind of stuff, and so we're doing videos. And in an intellectual property company, one of the things that we classified is a production company. So anytime I'm buying clothes and I go speak somewhere on stage, I write those off as a uniform because it's on camera. Now, I actually had a CPA at my last workshop say, how do you do that? And I had to tell her how to do it. She didn't know how, because she had always told people you can't write it off. But the thing is, I'm wearing different clothes and I consider them a uniform, and I keep them at the office and I keep them in the basement where we have another studio where we might film from my house. And so when I got audited years ago, it was allowed. Why? Here's the number one reason. I had a connection and a story. Your expenses become deductions if you have a story of how it relates to the business. I know they make it seem like it should be more complicated than that. It's actually that simple. So my CFO, if he's traveling somewhere, even though he's going to see family, but he's going to have at least one business meeting, he emails ahead of time. He documents that in a nice folder. What I do is I print out an American Express bill and I write with really sloppy handwriting what the expense was for. Just document. In whatever way you do it, don't let the excuse of getting it documented be something that holds you back. But turning your expenses into deductions is a really big deal to save a bunch of money. One word of caution now. If that expense that has become a deduction is 20% or more of your overall tax deductions for that year, just know that if it's ever disallowed, that's a 25% penalty. So just be careful with that. Make sure it's a really clear-cut story and that it's well documented, okay? So I like to pay my kids, I get to pay my kids $6,300, and that's tax-free. I'm actually paying them $1,000 a month because one of them's going through the Amazing Selling Machine course right now because we have a bunch of clients from amazing.com. So I pay him to go through that course, and he's going to be a business partner because I'm going to make him start a business so that he can get a real education and that we have a chance in this world, right? I love that you get all these extra, soapboxes in this. And then my other son, he's 8, so I'm writing a kid's book because I feel like I can really influence people on financial philosophy if I can keep it simple enough for an 8-year-old and put it in a book for kids. And then I can do a lot more fun media rather than adversarial media with like CNBC. So I'm paying my kids for that. So the first $6,300 is tax-free, but then the next piece is only 10% tax. That's a lot lower tax rate than what I'm paying. So that's turning an expense, because kids are an expense. Anyone have kids? They're expensive. Like I spend a lot more on them than I expected, but they're cute and you love them, so you're willing to do it. So I might as well make it a little bit tax efficient along the way. So turn your expenses into deductions. Then the next thing, so that's strategy 1. Strategy 2, reclassify your income. Reclassify your income. So if you don't have, there's so many ways to reclassify your income. At lunch, what I was talking about is because I have intellectual property, I can actually have a separate intellectual property company, and I can actually have some of my income be capital gain income. Capital gain for me is about half of what my ordinary income tax rate is. So every time I can get paid for intellectual property or the sale of that intellectual property, then all of a sudden that becomes a capital gain type of transaction, especially the way it's structured. There's more detail, but I'm just trying to get you to think. The other thing, taking ordinary income to capital gain, at lunch that we were talking about is, there was someone at lunch that was doing $7 million of revenue, so I said, hey, have you thought of setting up your own insurance company as a C Corp? You can put up to $1.2 million this year, $2.2 million next year, and then you can manage it like an insurance company, so it's conservative investing. But then if you ever have a risk that you need to pay for, that's tax-free. If you don't, you can pull that out and it's a capital gain. Once again, going from 40%, more like 20%. So that's one way to reclassify income. Let me give you the simplest way to reclassify income that will apply to everyone in the room to some degree, all right? So if you own a building, for example, charge yourself the highest possible rent because that's a 1099 more passive income than W-2. If you look at what you do on a daily basis, see what you would pay someone else to do the same thing, which should be less than what you're paying yourself, and only pay yourself that much or less in salary and take the rest of your income through distributions, because distributions don't get hit with self-employment tax. Self-employment tax is 15.3%. Even when that's maxed out, you still have Medicare and Medicaid at 3.2%. And when you're making more than $250,000, then it goes up to another 3.7% penalty for making an income. So if you can take it as a passive income instead of active, you avoid all that tax. So find every way you can do that, which might be the type of corporation you set up. You could be an S corporation and pay yourself what I call differentiating income, salary versus distributions. That would be an example of taking more passive income. Or once again, could you license your IP to your company? Because even if you don't do the big transaction I did, you're still going to get it where it's a 1099 type of structure versus a W-2, which will be lower taxes. So there's so many ways to reclassify income, and there's so many opportunities when you do that. So here's strategy number 3, or the third part of the framework, which is really on you first and foremost, but there's like 5 pieces to it, okay? The first thing is you gotta be proactive. If you're not actually meeting with your tax team every quarter, even if it's only for 10, 20 minutes, meeting with them before you send off your quarterlies, you're overpaying tax. If you're talking to your accountants right now about 2015's taxes, you overpaid. If you're not talking to your accounting team about 2017 and beyond right now, you're far too behind and you're gonna overpay on your taxes. So you wanna be proactive, which means if you don't like doing this stuff, hire a controller, hire someone that keeps this information for you so you could leverage and do the things that you're very best at. Then, if you found that you've been sloppy at all along the way, or you don't feel a high level of confidence in your accountant, or you just wanna do something that I would consider smart, every 3 years, have a different set of eyes look at your taxes, because you can go back 3 years and amend your returns. This just reminds me of my buddy. His name's Mike. He lives in Illinois. You know, talking to him, he joined our program way back in '08, and he's like, this is awesome. I'm like, cool. Next thing you're gonna do is meet with the accountant. He goes, oh, no, I don't need to meet with the accountant. I have the very best accountant in the world. And I'm like, what's the name of your town? Do you guys have an airport? And he's like, oh yeah, we have a private airport. I'm like, exactly. Like, I don't even know where that place is. You don't have the best accountant in the world, I assure you. So what we did is we looked back for the last 3 years and we found he'd missed $100,000 in tax advantages. So he was able to amend and get that money back. Plus, he wasn't incorporated, even though he's doing $1 million plus of revenue. You want to incorporate just to protect your ass, but also because you can save on tax. So we did the whole differentiating income thing I told you about. That was $10,000 a year for him in tax savings. But then he owned a building. Anyone here own their own commercial building by chance? If you own a commercial building, you can actually bring in an engineer, do what's called the cost segregation study, and we're able to get him another $10,000 a year in tax advantages, because normally you have to wait 39 years to get tax advantages fully on a building, but if you have an engineer come in, you might be able to get it in 3 years, 5 years, 7 years. So $20,000 a year moving forward, $100,000 back. I was right, he was wrong. I let him know it because I'm that kind of friend. And but at least I gave him a big check in doing that. Now, let's fast forward to 2013. He gets audited. So the first thing, because we're friends, he's like, I hate you, you're an asshole, I'm going to jail. I know this couldn't have been, it's too good to be true. I'm like, dude, don't even go to the audit, it's not even gonna matter. So I made a bet with him. If we didn't save him money in the audit, then I would pay whatever he owed if we didn't save him money. But if I saved him money, then he had to take me to a Chicago Bears game because he's a big Bears fan, all expenses paid, and it had to be good tickets and a decent hotel and take me to a nice restaurant. Basically, he became my bitch. right? If I could save him money or not. So that's what we did. We went back and we were able to go with the auditors and just basically be really nice to them, give them every bit of information they wanted and all the documents, and they just signed off on everything. It was very short. But at the end we said, hey, by the way, Mike doesn't really write off his vehicle, I think, very aggressive. What do you think? All of a sudden, because we were nice to them, and they're not always used to being treated that way, and because we were professional, we were organized, we were calculated with every deduction we had a story behind all the expenses, we got $5,500 more in tax deductions for him through the audit. So, needless to say, I spent $2,000 of that for him very easily because he was worried. So I just share that story because amending is a big deal. I had 2 partners die in a plane crash back in 2006, and for 4 months, I did not make good financial decisions. I just didn't communicate with my team. It was chaotic. I tried to keep our whole business going. We had 42 employees. It was very personality-based at that time. So I actually got to go back in 2008 and amend my returns from '06, and I got $54,000 back, and I do this every day. So if you get above $1 million in revenue, it's time to start considering a tax attorney to work with the CPA. If you're not meeting quarterly with your tax team, you're probably overpaying on your tax. And every 3 years, get a second set of eyes, even if you love your accounting team, to come in and see if there's anything that's been missed, because your team might get in a rut and always look at it the same way, or they might just miss some of the things that are out there and available to you. And so we did that with a guy in Florida, and we found $120,000 of additional tax deductions. His accountant only took advantage of like 35,000 of them, but I was like, we were just the second opinion firm. I mean, I think that was well worth the hour that he spent, and it's too bad that his accountant wouldn't see the whole picture, but whatever, I mean, it's still a bunch of money in his pocket, and there's a lot of money for you just by saving tax. So now you know the framework.
We're talking about tax, and you guys know what's funny about taxes? Nothing. No, taxes suck, right? They say there's only 2 things you can count on in life, death and taxes, which seems a bit redundant since most of you would rather die than pay your taxes. The government calls it a voluntary system. Yeah, you voluntarily pay or voluntarily go to jail. But at least we know our taxes are going to good use, right? I mean, in my home state of Utah, there's a thing that if you're over age 65, you can marry your cousin. Because, of course there is. I mean, it doesn't say how old she has to be, so that even seems creepier, right? I mean, this is an actual law that's been passed. You know how much time and money it takes to have a session with 75 state representatives, 29 state senators? Someone proposes the bill, then someone has to write the bill, then they amend the bill and debate the bill, and then have the governor sign off on it. Also, some 65-year-old perv can marry his cousins. And yeah, I went with cousins because it was Utah. Go polygamy and go Utes. Yeah. Yeah, but we get some tax breaks, right? Like I have kids, so they're a tax break because you brought future revenue opportunities to the government in the form of taxpayers. But the joke's on the government because my kids, they don't work. So we're going to talk a little bit about taxes. I might add a little bit of humor like that as we go through this, but what I want to make sure to really do is give you really practical things that help you keep more of what you make legally and ethically. Because look, you can make money, which is with your income. You can grow that money with investing, but there's a lot of opportunity to keep more of what you make without having to cut back. Most financial people want you to reduce, eliminate, cut back, don't increase your quality of life, but that sucks. That's going to slow you down because that creates a scarcity mindset. And scarcity is the greatest destroyer of wealth. No amount of luck, saving, discipline, rate of return, or financial advisor will save you if you're in scarcity because that repels wealth and doesn't build it. I want you to think more about being a productive person than reduction thinking. Produce instead of consume. What can you do to add more value, serve more people, solve bigger problems? And ultimately, there's almost no bigger line item of expense than taxes. So if I can help you reduce that, you can reinvest that back into your quality of life, into employees, into your business, whatever you want. And I will promise you, whatever you spend it on, it'll be more efficient than where it's currently going. Right? Or are you guys big government fans and want to just... the government's so good with money, they're $30 trillion in debt. That's a 30. How many zeros do you think follow that? For 2 years, I said it was 18 zeros. It's 13, but people don't even know at that point. It's it's a $1 million. People don't even know what to think about it. Man, that's crazy. You know how long it takes to count to 1 trillion? 32,000 years. You know what was going on 32,000 years ago? An ice age, Neanderthals were just around, Joe Biden had just been born. I mean, I'm not going to give you the type of tax advice that a lot of people give either, which is more about delaying tax, because there's a big difference between delaying tax and saving tax. Like most people's 401k looks like a 201k when they go to take their money out of it. Because saving tax means you don't have to pay. Delaying it means you don't have to pay right now. Because who doesn't want to wait till they're older and crankier to finally pay their taxes? That's why I think retirement plans are crazy. Who wants to wait till they're 85 to finally enjoy life? Go jet skiing when you might break a hip? You're not going to get crunk up in the club when you're 85? Shit, I can't even do that today. The only thing that happens when you're 85 is you wake up. And some days you wish that wouldn't occur. Your body aches, your eyes are swollen shut, and now you got to go be president, right? Oh, God. I'll actually get to some content in a minute. We're just going to make fun of taxes for a bit. All right. So let me create some context before we get there. Like, how many people here have ever heard or even said that you should live within your means? That's good advice, but there's 3 ways to live within your means. The first way is to reduce, to cut back, to budget. And unfortunately, that is not the road to wealth. No one shrinks their way to wealth. The second way is to be more efficient within your means. There's 4 ways to be more efficient, or the 4 I's. One is the IRS, stop tipping the government. Like, look, I like tipping. It's a great way to say thank you, job well done. Not something I associate with the government. It's like tipping a waiter who ate 37.5% of your meal and peed in your soup. I've been doing a lot of comedy, so I can't help myself. It just happens. So number 1 is the IRS. That's how we be more efficient, pay them less legally and ethically. The second is interest. You know, if you have the right credit score, the right collateral, the right cash flow reporting, or the right connections, you're going to pay less in interest and therefore keep more money rather than give it to institutions. The third I is investments, especially investments in the traditional sense where people are giving their money to investment advisors that they know nothing about the investments they're getting into, but they're paying a lot of non-performing fees, a lot of expenses, and unfortunately not protecting their downside. And ultimately, I'm here, like, this is just a personal opinion, but I'm here to basically tell people to never invest in the stock market ever again for the rest of their life. Let me just get on a soapbox for 1 minute here. First off, there's a fiduciary responsibility for publicly traded companies only to the shareholders, not to employees and not to customers. So we continue to see something wrought with fraud where they continue to do things on the backs of employees and not helping them and hurting their customers just so they can get more, so they can continue to raise their stock price so a bunch of hedge fund assholes can get even more rich. Like, I'd rather vote with my dollar than go vote for someone who's always going to be inept when they get into politics. Like, and when we vote with our dollar, why vote for companies that you would never want to do business with? I believe you should invest in yourself, in your skill sets, in your aptitude, and in the investments that you create cash flow, not accumulate. This notion of accumulation is a stupid, antiquated, old philosophy that says, hey, buy a mutual fund, put money away often, early, and always. Set it and forget it. Wait for 30 years, and then one day, someday, you can finally enjoy life when you're too old to enjoy it, like I said before. It's a crazy notion. I believe in the things that Jeff was saying, economic independence, where you have enough cash flow coming from your balance sheet to cover your basic expenses, so every active dollar you earn can buy more assets. That's 10 times better than this notion of retirement plans. Well, I'm going to take 10% of my income and try to earn 10% on something that's not going to produce 10% because we're still stuck in the 90s, quoting in returns that don't even exist today, and pay a bunch of investment fees to people who can make money whether you make money or not, so that one day, someday, you can be told only to live off the interest. That's a dumb idea. Let's build up a bunch of assets and only live off the interest so the institutions can lend that out over and over and over again through fractionalized banking. Not that I have an opinion or any passion towards this dumbass shit, but ultimately, the whole notion is they try to tell you it's complicated, you can't understand it, and you need to trust these other people who are merely salespeople that pose like planners. Planners are going to say, are you saving tax? Have you have the proper asset protection? Or what are you really good at? Let's make sure you invest in that. They're not going to try to talk you out of your real estate deals. They're going to encourage that if that's where your expertise is, because you all have investor DNA. Investor DNA is your values, like what matters to you. That's your script for how to operate. It's your competencies. What are you good at? It's their drivers. What things do you want to pay attention to? And the rule is focus, don't diversify. Diversification is diversification when it's spreading up against a bunch of different stocks you know nothing about. Owning two mutual funds is not diversification, it's stupidity. Diversification is when you're wealthy. Focus is the way that you get wealthy with things that you know and that are aligned with that investor DNA that you have. So risk is in the investor, not the investment. So what's a good investment for one person might not be for the next person. All right, back to this thing I was talking about. 3 ways to live within your means. 1 is you can budget. 2 is you can be more efficient. There's a few ways to be more efficient. The first way was the IRS. We're going to emphasize some time on that. And if you want, I can speak faster. Just let me know by giving me a thumbs up. Second was interest. Pay less in interest by having the right kind of structure that gives you the best types of deals, the right types of connections, like with private bankers, or the right types of investors. And then third, we're talking about investments. Protect the downside. Look for non-performing fees and remove those, like a financial detective. Because here's the deal. If you had $1 million, or let's say $100,000 sitting in a retirement plan, and they show you earning 10% for the next 30 years, that grows to $1.74 million. That sounds awesome. It's never going to happen, but it sounds great. But let's say you had less than 1% in fees, 80 bips, 0.8% in fees. That $100,000 grows to $1.4 million, which is $340,000 less because it's exponential and logarithmic. But they want you to think in percentages rather than the bottom line dollars and cents. So I want you to remove drag. I want you to stop investing in things you don't know, invest more in yourself and into things that cash flow rather than accumulating and setting things into plans that you might never touch. Look, when my grandma turned 70.5 and I said, Grandma, you got to take money out of your retirement plan, otherwise there's a required minimum distribution that charges 50% penalty plus your normal tax rate. It was the first time I heard her say the F word, not the last. I mean, once that dam broke, it was over. It was over. But she was mad because if you hate paying tax today, you're not going to hate paying it less in the future. So the fourth I is insurance. A lot of people have duplicate coverages, improper structure. They don't know how to properly transfer risk, and they buy expensive insurance, which are things that insure inconsequential things you can afford on your own, and they don't transfer the catastrophic things. So I'll say that clearly. You only use insurance for catastrophic risk, never anything inconsequential. Inconsequential is you can write a check today and go to sleep tonight, and you're not going to lose sleep. Inconsequential. Those are the things that cost the most because the first dollar you pay for insurance is the most expensive dollar. The last dollar is the least expensive because it's the least likely to occur, but the most damaging if it does. Does that make sense? I can go. Some people are staring at me. Okay, cool. You would just look mad, sir. I was making sure we were on the same page. Okay, so we got 3 ways to live within your means. I've covered 2. You could budget. Budgeting sucks. Or you can be more efficient within your means. Or you can expand your means. That's why you're here. That's what these guys are amazing at doing, is helping people expand their means, add more value, serve more people, make more money. You're not just looking about what you can hold on to, because when people get stuck in scarcity, they often lose sight of what they can do to provide value for others, and they only think about what they could do to survive for themselves. And as I said before, no one shrinks their way to wealth. Okay, so there's the framework. We've told a few jokes. We've got a few philosophies. Now let's get super practical. I want you to draw 2 vertical lines so that we basically have 3 buckets. On the left bucket, I want you to write team. The middle bucket, I want you to write deductions. And on the right-hand bucket, I want you to write reclassification. I'm going to give you a tax framework. It works in any country, but I'm going to tell you I'm only going to talk about US-based tax strategy because otherwise it's just going to take too long. Is any Canadians here? Yeah, fuck Canada. We don't have to do anything. Oh, there's one. I just came back from Muskoka. I was there last week, and someone told me that Muskoka was the Hamptons of Canada. It's like the Hampton Inn of Canada, is what I thought. So anyway, I'll make sure to add some A's in process and boots,
and apologize every so often. Sorry for the negative comment. Okay. So let's look at the team. There's really up to 4 people that are going to be essential for your tax team. And this is the easiest thing to understand, sometimes the hardest thing to implement. The first thing is whoever's going to help you with data. This might be a part-time bookkeeper if you're a smaller business. It might be a full-time bookkeeper. It might be a controller that's handling payroll. Or it might be a CFO that's creating pro formas. But what I find is people don't have timely data, they overpay on their taxes. And we did a survey where we talked to 117 clients, and 107 overpaid their taxes that we just randomly called clients that we were working with that year. So 107 out of 117 had overpaid. The average overpayment was like $11,430 per $250,000 of revenue, so it was substantial. The second place on the team is a tax strategist. And a tax strategist is very different than a tax historian. Tax historians are the ones that say, you had a good year, here's what you owe. It's smug and it's going to piss you off. A tax strategist needs to meet with you at least quarterly through the year to say, how can we navigate this tax code? Because the first 300 pages of the tax code say why you have to pay taxes as a W-2 employee. The next several thousand pages say, here's the tax-free roadmap that you don't have to pay if you're providing value as a business owner. So unfortunately, if we look at the accounting world, they're trained in a reactionary state. They're looking to acquire new clients and file taxes, for them, and often that's what they're doing is filing taxes and not strategizing. So you might have a CPA that's a historian, and someone else might have a CPA that's a strategist. Here's the verbiage of a historian. Here's their favorite statements. Tell me if you've heard this one. I'm conservative. Let me interpret that. I'm antiquated. I'm lazy. You are going to pay too much in tax, but I want you to be scared of the government and the IRS, so you'll stay with me. Jeff, is that fair? You were in D.C. for 5 years as what were you, a tax whatever? Tax lobbyist. We have a damn tax lobbyist here. So he was lobbying for you to pay less tax, so I like that. All right, so that's some of the verbiage you might hear, or, they'll say stuff like, well, you can't write off a home office. Yes, you can. It's right there. I could show you. It's black and white in the law. Or I'll say, hey, you should use the Augusta rule. What's the tax code on the Augusta rule so that they can write that down for the people who don't believe it? 280 HG, AG, 280 AG. And what that says is you could rent your home out to your business for 14 days a year, write it off for the business, and not claim that as personal income. That would also work if you rent it out to someone else, and that money would come in tax-free. Yet I find most accountants don't know that. So the tax strategist is going to be mostly responsible for bucket number 2, called deductions. Okay? The third person on the team, and this depends on your size as to what type of person it's going to be, but it's going to be an attorney. I know Jeff said he didn't like talking to attorneys. I was telling Brian, who's going to speak tomorrow, and an amazing guy. Actually, I actually read the book on your table. I thought it was an amazing book. I actually endorsed it. Don't know if my endorsement made the book, but I endorsed it anyway, and it was the only book I read that year, so I was really proud of myself. Thanks, Brian. I write books. I don't read. I'm not paid to read. Nobody's paid me for that, so yeah. So the third one is an attorney, and that's either going to be a corporate attorney if your business isn't doing $1 million of revenue, or a tax attorney if you're doing more than that. Like, what would you say? $650,000 of net income would probably be the threshold of where you start considering a tax attorney. Now, for me, Jeff is the one that's he saves me 6 figures a year in tax. I know he didn't give a tax talk. They said, Jeff's not entertaining enough to do a tax talk, so you talk on tax even though he knows more than you about it. So he looks like Norm Macdonald, just not as funny. So I don't know why we're friends, because all I do is give him shit all the time. But a tax attorney, for me, is about 2/3 of my tax strategy. The tax attorney is going to be responsible for the reclassification bucket, where the most major things are. Look, you can write everything off in your life and then not be able to get a loan. You can write off so much in your business that if you ever try to sell it, it looks like it was a place where you just stole money from every single day, and a lot of business owners do that. They treat it like a lifestyle rather than a business,
But I make sure in my business, I'm not able to do anything an employee wouldn't be able to do. So I don't have a business credit card that I just charge. I don't pay for a car out of the business. I have a different entity that I do those types of things out of without partners, and that is never going to be sold because it's just my intellectual property company. So ultimately, the tax attorney is going to be really helpful. And then the fourth one, most of you probably already know if you own commercial property, is a cost segregation engineer. So you can look at doing that cost segregation study, accelerate your depreciation. If you own any commercial property, I would definitely look into that. I'm sure there's like 100 people here in the room that could tell you about what that is. All right, so that's the team. I like to have that team on the phone, and when I'm on the phone with them, we actually have a call coming up next week that Jeff's on, and what I do is I think like an entrepreneur. I'm not talking to the IRS, and we're not actually going to implement everything that I talk about, but on that call I'll say, headed to Italy, I'd like to write off the trip. They giggle, they laugh, I go, no. Like, let's think about it. Here's the number of clients that are coming over the 2 months while we're in Italy, so even though, they're friends and clients, I'm going to do an immersion. Sometimes I do like 10 immersions a year where I'll meet with someone one-on-one. I did an immersion while I was there. I said, let's go to where my family was from and film, and then that could be part of this documentary thing that we're doing. And by the end of the call, 55% of the trip's a write-off. So when they say no, I'll say, in what instances or what businesses could this be a write-off? And what's the coolest thing that you've done for a client since we talked last? Is there any new updates or rule changes? And what you do is you just brainstorm, and then a lot of it gets thrown out. Like we were brainstorming with Jeff once, and he's like, well, you're going to do this renovation to the office. Your father-in-law is a contractor. You could pay him at his tax rate, and you'll write the full thing off, but then his income will be less, and then he can gift that money to you. And I was like, that's a good idea. It's just not what we're actually doing, so I don't want to be unethical. So thanks for the unethical advice, Jeff. No, but this is the thing. We're just brainstorming on the call, and then we're deciding what's real after the call. And I remember the tax attorney on that call said, well, Garrett, sometimes you just make a lot of money and you should get used to paying taxes. And guess who hasn't ever been on the call again? Yeah. So, all right, so that's the team. Let's move to this next bucket of tax deductions. So if you're a business owner, anytime you spend money, number one, I want you to document all your spending and just ask this question. Could this relate to my business? Not does this, or is this definitive? Could this relate? I bought a Can-Am. Anyone know what a Can-Am is? Like super fast, go-kart looking, Batmobile looking things, that none of my family will ride with me because they're a bunch of pussies. So, sorry, I don't know if we have like a no swearing clause in this thing. Okay, cool. Because I just signed a speaker agreement for later this month where they said no swearing, and I was like, okay, got it. So I get on the phone with them, I'm like, can we write this off? They laugh again. I said, no, look, I host my immersions at the cabin. We can take people for a ride in it, and at the beginning of my podcast, we have video of it, so it turns out we could write off like 50% of it by the end of the phone call. Again, you want to have these conversations and then say, can I write this off, or in what instance could I? I remember I was doing a lot of videos, and I said, hey, can I write this off because I bought these clothes and all this? They said, no, that's not an official uniform. You can wear it out every day. I said, yeah, but I'm pretty sure all these Hollywood movies, they're buying stuff and writing it off, and it's just regular clothes for the most part. They said, yeah, but they're a production company. And I said, great. My intellectual property company will change the operating agreement. It's now a production company because it's producing videos all the time, and now I could write it off. So classification will matter in those instances. So number one in deductions, we're saying, okay, where are we spending money? And then number two, could this relate to my business? And then you talk to them on a quarterly basis. So I wrote down some other deductions that I think everyone should consider. How many people in the room have W-2 employees by a show of hands? W-2 employees. If you have W-2 employees, the employee retention credit has been sweetened. It was $7,000 for the year 2020, and there were some qualifications, like you had to be impacted by COVID. But now it's basically, did you sneeze once in 2021? Great, you're now qualified for it. And it's now up to $21,000, I believe, for 2021 per employee, plus the 2020. So we just had a dentist get back $500,000 for employee retention credits. So did you keep employees during COVID? Are they W-2? That would be something to look into as far as deductions go. And again, here's the deal. Do you want connections on how to do some of these things? All right, so I'm just going to give you David's personal cell number because I just for a decent time, you can call this. But I'm happy just to make the connections on some of these things so that you can implement what we're talking about. I mean, I'm actually not really in the financial game at this level anymore. I sold my business last year so people could laugh at my jokes, which feels a lot better than apparently making shitloads of money. So that's what I decided to do. David is about to have a baby next month, so he won't be sleeping, so he should answer his phone at all times. The phone number is 385-887-3587. 385-887-3587. David Gowns, why don't you stand up? You should see, he's the one with the shiny head over there. So, all right. The other thing is R&D credits. If you've done anything with technology, you've built a website, you've adapted your your database, your customer, you have an app or any of that kind of stuff, and you did it here in the United States, you can go back and get credits. It's beyond what you've spent. It has to do with time. So I got back $91,000 doing this, just going back, and you can amend returns, because if you've missed certain things, you can go back and get them. Some things when you miss, tough luck, but other things, you can get the money back. Every now and again, people say, well, is that going to draw a red flag? I'm like, you're showing them why you're getting it back, and they're paying you. I don't, has that ever caused a red flag or an audit, as far as you know? I mean, first off, I'm not going to teach you about offshore strategies that are going to raise red flags. I just believe in doing the legal and ethical things within the law to the highest degree. So I've been audited twice in my life. I've never been to an audit because that's the first rule. And I got money back in one of them, and the other one I owed nothing, because my plan is to always, we're super organized, my tax team talks to them, and they go on the offensive. Hey, we didn't write this off. Do you think we could write this off? Hey, we didn't write this off. Do you think we could write this off? And guess what? Sometimes you get to write more things off. I actually got in a bet with one of my clients because he told me he had the best accountant in the world. This was his words. I have the best accountant in the world. I said, really? You live in nowhere, Illinois, and you have the best accountant in the world? He says, yes. I said, well, here's the deal. You're a Bears fan, so if you'll just meet with our accounting team, we're going to look back 3 years and see if we can amend anything, and we're going to see, moving forward, what might be missed. If we don't find anything, I'll take you to the game, and I'll take you to a steakhouse. If we find something, then you'll take me. So we found $100,000 going back. He had a commercial building, hadn't cost segregated. He didn't even have a corporation set up, so we set up an S corporation, let him take some salary, some dividends. That avoids self-employment tax, which saved 15.3% on some of his income. And then what else did we do? There was one other major strategy. I think it was the R&D. So $100,000 going back, and then $20,000 a year moving forward. So he then takes me to a Jacksonville Jaguars game at the very top of Soldier Stadium because he's an asshole, right? I'm like, dude, that's a lot of money I got you. So 4.5 years later, we fast forward, he calls me, he says, I'm going to jail. I said, I'm not surprised for what? He goes, it's got to be for tax evasion. I am getting audited, and there's no way what we did was legal. I said, not only was it legal, you're such a pansy, we didn't save all the money that could have been saved. So if we save you more, I get 50-yard line this time, divisional rival game within the lower bowl. And guess what? We saved him. It wasn't a lot, $5,000. But there was nothing to worry about because we were organized. We had the details. We weren't doing anything that was, offshore or kind of aggressive. These are just things that are available. So employee retention credits, R&D. I mentioned the Augusta rule where you could rent out your house. Now, some people say, well, I have more than one home. Can I do it for all homes? It's vague. Don't know. I've been testing it out. I have a nice cabin, and I have a house. So last year, we did write-offs on both places. I'll tell you when I get audited what they say. The reason I'm not worried is because what if they go, oh, we can only allow one? What's the worst that's going to happen to me? I'm going to pay 9%. Plus, I don't know if you guys have seen how well the government's operating right now. I'm not worried. They sent me a letter in 2020 that they wanted to audit something that I was doing. I'm in risk management. I'm like, great, I welcome it, but here's the questions I have for you. And then I just got a letter saying there's no reason to meet. I don't know why we're afraid of people that are working for this entity. Scientology's never been afraid of them. These just come to my head in the moment for you guys' entertainment. The other thing on the deduction side that I want to mention is I pay both of my kids, my 14 and 17-year-old, $1,200 a month. That's completely tax-free to them. I control the money still. I make them do the work for it. And ultimately, that's a write-off for me. So you can pay him more than that, but that's the level that's tax-free. So that's like, $24,000 write-off every single year just because the income's going to them and I'm getting a tax deduction for them as employees. And, they're my worst employees, just by the way. I mean, they're overpaid at $12,000, but I'm just putting it into therapy for the future. So, okay, any questions on the deduction side? So that's your tax strategist, should be really helping you with deductions. And we talked about employee retention credits, we talked about R&D credits, we've talked about paying kids, we talked about the Augusta rule. Actually, Jeff just taught me about 132J4 we were both, what event were we at? Oh, my other event I was hosting in Austin. And so I'm now putting in a pool at my house, which will be a lot of fun and a nice tax write-off. But it's fun first and foremost. Like, I'm not a guy that goes out and gets a tax advantage first. Like, don't let the tax tail wag the dog. It needs to make economic sense first and then tax sense second. If anybody remembers the days of the 80s where negative gearing was going on, people are buying real estate, they're writing it off, and Reagan was like, we're not going to allow that anymore, and now they had real estate that wasn't worth anything because it was just a tax write-off. Think fundamentals, think economics, then think tax write-off, and now we're getting to the big stuff, the reclassification, that third bucket. There's really 4 parts to the reclassification. The first is if you could turn active income into passive income. And again, Jeff talked about that. Your most expensive income is your most active income, the W-2. But passive can save you tax. Even as it's simple of 3.2% on the income that's coming through in 1099, once you've maxed out FICA FUTA, but you might even be able to save up to 15.3%. So obviously real estate is going to qualify for, being more passive related income. You can differentiate your income as a business owner where you take some salary, which is considered reasonable salary, which isn't what you're worth. It's what you would pay someone else to do that job on average, not at the high level. And then that's paid at a certain level. And then you take the rest as dividends or distributions and you save yourself tax on that. So that's moving active to passive. The second is ordinary income to capital gains. So obviously with real estate, you have appreciation of that value, that's capital gains. This is where I would say it would be insane if it's anything other than a Roth, and I don't, unless you're converting to a Roth or you're not making a lot of money, you probably can't even do one. But I would never put real estate in a qualified plan because now you're taking a capital gain asset and making ordinary income. Now you're taking an asset that you can depreciate and lower and minimize and eliminate all depreciation. You're merely deferring tax in that situation, not saving it. So how do we go from ordinary income to capital gains? We mentioned, one example with real estate. There's something called an 831B, and as I tell you this does increase your audit risk. And the firm you go with will be the difference of you being able to do this or not do this because it's abused a lot of times. But how many of you have heard of a captive insurance agency? So captive insurance agency means you can put up to $2.3 million into your own insurance company, invest that money like an insurance company, and if you don't have an insurance claim for your businesses, you can take that money out as capital gains. Unfortunately, a lot of people put things inside of those that they're not allowed to do, or they abuse it, and then any attorney that's working with that client, every other client that they're working with, now gets audited. So that is something that would increase your audit risk, but every Fortune 500 company has one. Even, tons of smaller companies have them. You just have to make sure to do it right. Another one is in ICDISC. If you're doing business internationally, you can move international money through an international sales corporation and pay capital gains to bring it back to the United States rather than ordinary income. All right, third piece of reclassification, tax-free. If you have a C corporation that's been around for at least 5 years and sells for up to $10 million, no tax on that. That's a 1202. That's known as a 1202. Or let's say you have a bunch of real estate and you want to eventually exit it and not just 1031 it to something else. Well, at that point, you can do a charitable remainder trust and you can donate it to your favorite charity. It's got to be real. Some people are like, oh, I'm going to invent my own charity. Great, you can do that. You're just going to be scrutinized, and if you don't do it right, it will eliminate the tax advantage. But now you can sell that piece of real estate and all the gains will be tax-free and you'll get a partial tax deduction for the donation. You can now take income from that charitable trust for the rest of your life between 5% and 50%, depending on where you invest the underlying asset and your age. So now you're finding this full amount of income off of the full asset with the tax deduction that you can use for that year plus up to 5 years later. Charitable trust. There's donor advised funds. Let's go into the last one here, which is tax arbitrage. Tax arbitrage is a fancy term to say, I never spend $1 to save 35 cents. I only spend $1 to save more than $1. So for example, I bought a lot of artwork. I have an art dealer that will let me buy collections of art for 25 cents on the dollar. After I've held that art for 3 years, I can donate it to museums, and for every dollar I spend, I get $2 back in tax. That's tax arbitrage. Now, it has to be a legitimately appraised asset. It has to be an actual place that you're donating. I've donated to a bunch of universities primarily that have museums, and then I get invited to stuff I never go to, right? But it's pretty cool that I can actually display it, use it, and then I can donate it. You guys are in real estate, you probably know a lot about conservation easements. Now, I know there's a lot of syndication where people come and do those, and they get with unrelated parties. But you might have property that you go, hey, I never want to develop this. If you give up the development rights, you can get tax advantages based upon the value of that development right collapsed right now. Now, if you go do that with unrelated parties, that's where it gets a little bit more complicated, and yes, you're more likely to actually get audited. Historic easements. You can buy a historical building, and you can actually protect the facade, get a tax advantage for that, but still rent that out. What you're doing is promising you'll never tear it down and change the historical nature of that building. So these are all tax arbitrage things where those kind of things might even pay for the real estate as is. Like I have 44 acres outside of my cabin where I've been trying to get the city to approve certain development for it, letting them know I'm not going to develop it, I'm just going to do a conservation easement, but if they'll change the development on it, I can pay for the land and get it for free with all the tax advantages, right? So those are some of the things that you can start to look at. So hopefully this framework helps you. The proper team, number one, the proper deductions, we're using a tax strategist, and the reclassification that the attorney helps you with. The type of corporation you use matters. Like an LLC or an S-Corp or pass-through entities, you can't retain earnings in those. LLCs that don't have partnerships aren't always the thing that make the most sense unless you're holding real estate in it. C-Corps, you can retain earnings in that kind of thing, but your type of corporation will impact your taxes. And a lot of accountants say, well, you don't need to set up a corporation only because they're not attorneys. You want an attorney and an accountant. Let the accountant help you with deductions. Let the attorney help you with asset protection and reclassification of income.
Now, some of it is an investment towards services we use on a daily basis. Taxes can fund areas that create safety and infrastructure, the types of services that benefit our lives. And some of it goes to places that aren't so helpful because of bureaucracy and waste. You hear statements like, tax the rich, that's what they say, right? Or are people paying their fair share? Well, that's another question. But either way, I want you to know how to stop the leaks. I want you to stop tipping the government and only pay what you truly owe. In this video, I'm going to share the framework on what you can do to save money legally and ethically. First, and this is critical, best tax advice I can give, better than any tax shelter or any idea around taxes, it always makes sense to earn another dollar. Now, I know people that said in the past if they earn more money, it would kill them with taxes. They'd get killed with taxes. That's from my hometown. I'd hear that with coal miners that had to work overtime. There's some key distinctions to really understand. Consider this a public service announcement or a commercial, if you will. You know, the one that ends in, the more you know, with the little rainbow that comes across? There's marginal rate with your taxes and there's average rate. So to keep the math simple, if you made $100,000 and you paid $17,000 in tax, that's a 17% average rate. But the marginal rate says, well, the first dollars you earn up to a certain amount, let's just say $30,000, is only taxed at 10%. No matter how much more money you earn, those first dollars aren't going to be taxed at a higher rate. So it's a step, right? And then the next step is another kind of, range. And maybe that's $30,000 to $70,000, you might be paying 15%. But it doesn't tax the previous dollars higher. Then the next step is, well, maybe you go up to 25% for the rest of your money. So on average, you're at 70%, even though your marginal rate might be 25%. So that's good news. It means you can always earn more money without impacting your previous dollars or raising the tax rate. And here's even better news. When you save tax, it's on the last dollar you earn, meaning at your highest marginal rate. So you're going to save the highest percentage when you go through tax strategy. So let me say this again. Earning another dollar is always your best bet with taxes. Pay more taxes by earning more, and you'll still have more money in your pocket, even if you pay the government more. This will add more value to society, to yourself, and actually improve the world. The best way to help you save on tax is by giving you a framework. The laws are different in each country. The laws change from year to year as well. So unless you love reading tax code, and I know there's probably people that do, or legalese, I want to ease your mind with something that can cut through the noise and help you keep more of what you make. This framework is built with 3 buckets. So if you have some paper or an iPad or something, I want you to draw 2 vertical lines so you have these 3 different sections, and let's go. The first section or the first bucket is your team. The second one I want you to label is deductions, and the third is reclassification. Okay, let's start with your team. Now there's up to 4 people you might have on your team. Now if you're just starting out, or maybe you're a student, you don't have much money, maybe you're the person. But as you start to gain momentum, as you have profitability, I want you to make sure you have timely data. So the first person on your team is either a bookkeeper that just goes through and says, here's what your expenses are and here's what your income is, right? In business, they track your profit and loss, or if in personal finance, just your overall banking, right? Or if you're a business that has payroll, maybe you hire a controller. So they're doing bookkeeping and they're handling payroll. Or if you're a bigger business, it might be a CFO. Right, that CFO is a financial officer that can use pro formas and do projections and look at your margins. So very, very critical to have timely data. If you're getting your data together like I did when I was 19 years old, on April the 14th, I'd open the shoebox and what are all the receipts that I had? Not very good. There's apps that are out there. There's plenty of easy ways to do this. The way that I do it is we just use QuickBooks because I'm a business owner and I just look over that and have a printout that I look at every single Monday. Now the second person on your team, very important person, is a tax strategist. This isn't always a CPA if you live in America. There's enrolled agents. There's even just people that were tax lobbyists that might be really good at navigating this, or even entrepreneurial thinkers that have an emphasis in tax. Sometimes people on the tax side are more historians telling you what to file, looking retroactively at what you've earned, versus a strategist which proactively navigates your deductions, which is going to be that second bucket. The third person on your team is an attorney. If you have a side hustle or 1099 income or a business or a bunch of real estate, you want to set up the right corporation. Not only will it help you from a liability perspective, but it can also help you from a tax perspective. And if you are a business owner without a corporation, you have a 400% higher chance of being audited and unlimited personal liability. So you can protect liability and tax. Now, if you're making millions, you want a tax attorney. It might just be a basic corporate attorney if you're just starting a business or you don't have a huge amount of revenue coming in. And finally, this is an option only really if you have a commercial property. Maybe you have a business and you office inside of a property that you own, or maybe you own 4plexes or bigger. Then you might want a cost segregation engineer. They can work with your tax strategist and do an analysis that allows you to accelerate your depreciation for tax purposes with your real estate. Once again, commercial real estate. So that's the team. Bookkeeper, controller, or CFO. Number 1, timely data matters. Number 2, tax strategist to proactively help you navigate your taxes. And I'm going to tell you at the end of this video how often you want to meet with them. Third is an attorney, either a corporate attorney or if you have more money, a tax attorney. I just met with a tax attorney today, specializing in intellectual property. And fourth would be an engineer, cost segregation in particular. Excuse me for just a second. I know I'm interrupting your video, but it's because I'm really excited about this. Disrupting Sacred Cows, my newest book. It's new, it's fresh. It's about all of the things that have to do with our relationship to money, the things that hold us back, and how to, kind of peek into that, be able to resolve that. And ultimately, with the new economy and everything that's happening and moving so quickly, it is timely to help you to have more success in your finances. So go ahead and click the link if you want to grab this book and dive on in. Now, it's awesome if these different people on your team communicate with each other, or if they have all this in-house, even better, but sometimes they need to collaborate in order to maximize everything that's going on. So let's go to the second bucket, and here's where I'm going to put a bunch of money in your pocket, especially if you're a business owner. This is deductions. So if you own any business, a side hustle, you have 1099 income, you have a business, ask anytime you're spending money, could it connect to your business? And if it does, document. Now, maybe not everything is going to connect to your business. I've taken trips to Italy, but I got to write off part of that for my annual corporate meetings by doing our corporate meeting there. I've bought a Can-Am, which it looks like a Batmobile, and I can write off a portion of that because in my podcast studio, when I have my guests, we go out for rides on that. It's in the opening credits in the videos. So there's a portion I could write off, but that comes from having these meetings with the team and saying, in what ways could we write this off and does it count or not? Now, here's examples of deductions, and these are major ones. Right now, at the time this video is released, it might not be around in the future, is employee retention retention credits. If your business was impacted by COVID, you had COVID, an employee had COVID, the rules are they're not very stringent. They're kind of loose. You can get like $6,000 for 2020 per employee in credits, and then up to like $21,000 in 2021 for employee retention credits. I was just talking to someone that gets $1.8 million in employee retention credits. $1.8 million. That's substantial. So obviously they have like 900 employees, but this has even worked for someone with just a couple employees. If you have W-2 employees that aren't related to you, that's something to check into. Number 2, R&D credits. Have you ever built a website and used people domestically to do that? Have you, built an app or improved your CRM? You might have R&D credits coming to you, and if you've missed them, you can go back and get them from the past. Here's another one, the Augusta rule. Maybe you have a home or a cabin and you do things for the business every now and again. Well, when you do that, you can write that off for up to 14 times a year by renting it to your business and not have to pay income tax. So it's a deduction without the income tax. Home office, that's something that for some reason a lot of accountants miss, but that can mean part of your utilities, and a portion of the home can actually be a write-off for you. There's even a code for pool and gym maintenance. If you have that inside of your home, which I have both, and I'm able to write off the maintenance for that, or Section 199A. Section 199A says it's a pass-through deduction that says based upon your income and employees, it reduces your income because of a credit for earned income, 199A. If you don't know about that, that could be huge. So those are just a few examples of deductions, and a lot of people miss these because a lot of accounts are really busy. They've just got a lot of things that they're filing, and they get paid per filing, and so often they don't really have a lot of time to talk to people, so you want to make sure to have the right people on your team. Now, this is the big one, because we started with the team, which can be a little bit hard to kind of, get the right team. The second thing is really deductions, which a lot of people think about their deductions, but this is the part that most people miss, and this is called reclassifying your income. And there's 4 different ways to reclassify your income. The first is taking active income and making it passive. I'll give you some examples. The second is taking ordinary income and making it capital gains. The third is tax-free income, kind of nice. And the fourth sounds really complicated. It's not. It's called tax arbitrage. We'll talk more about what that is here in a second. So let's look at this. Active to passive income can mean, hey, if I'm an S corporation, I can take a salary and I pay, all sorts of taxes on that, including self-employment tax. But if I take distributions on anything above my reasonable salary, I don't have to pay somewhere between 3.2% and 15.3%, depending on how much income comes through there, simply because it's now classified passive. Or investment income, 1099 income, doesn't have all that self-employment tax, again, saving you between 3.2 to 15.3%. So the second way to reclassify income is take ordinary income and make it capital gains. I've done this because I have a business, and so in selling my business in 2021, that was capital gains. Long-term capital gains was not quite half of what ordinary income was, but it was quite a bit lower, so that was super helpful. If you're doing business internationally, you can look into an ICDISC, or an international sales corporation, and the money you bring into America from other countries, that could be capital gains. Or there's something called an 831B, which is a captive insurance agency, which I happen to have one, which allows me to have my own insurance. So when I'm out there speaking and doing these videos, I can insure those things rather than using an insurance company. The money goes in pre-tax, and if I don't make a claim, which I have made one during COVID, because I went from speaking all the time to staying home. And my wife's like, are you ever going to leave the house? I mean, I love you, but she thought I was here a little too often. So now she really supports me going out on tour and doing some comedy and then missing me a little bit, and I come back. So I'm able to put money into that pre-tax. If I don't have a claim, I can take it out capital gains. It's just an example. There's a higher audit risk with those. There's a lot of people that abuse those, so you have to be really careful. I'm just giving you examples. The next thing is tax-free. Let's say, again, you're a business owner and you have a C corporation and it's been around for at least 5 years. You might be able to sell that up to $10 million tax-free through Section 1202. Or a charitable trust where you can donate a highly appreciated capital gain asset like a business, a piece of real estate, or a stock, and donate it and get a partial tax deduction for the donation, sell it, pay no tax, and then get income off of that during your lifetime, leaving around 10% or at least 10% to the charity. So instead of giving the government money, you give it to a charity. There's even donor-advised funds that you can look into. Now, tax arbitrage, and this is important, means I spend $1 and I get more than $1 back. A lot of people let the tax tail wag the dog. They go, I'm going to go buy something to save tax, but they spend $1 to save 35 cents. So they've really lost 65 cents if it wasn't something they would have bought otherwise. So think economics first, tax second. But tax arbitrage, I have some art to the right of me that I was able to buy a big, collection of art that I then, after 3 years, started to donate that art, and I got to write off the value of what it was appraised for at that time, which was much higher than what I paid for because I bought it in a collection. Or there's something called a historic easement, where you can buy properties and you protect the facade of that to keep the historic facade, and you can still rent it out or utilize it, but you get an easement that accelerates this tax advantage for you. There's things like conservation easements that are similar, but again, be careful with those. Some of those have been abused, but you basically give up your development rights so that you can't tear it down and do something different, and you get a tax advantage for that. So here's your tax framework. Build the right team, maximize your deductions, and then reclassify your income. Now, the way to utilize this framework is a 3x3x3. So number one, 3 buckets. Number two, every 3 months you meet with your team and just say, hey, here's where we're at with income, here's some ideas, and what kind of strategies can we bring up? These bring me so much strategy. I just ask questions like, what's the coolest thing you've done for any other client? Or is there anything new that's out there? Or can I write this off? And sometimes we laugh because I ask about writing off absurd things, and other times we can actually write it off. And then every 3 years, look back to see if you've missed something. We mentioned R&D credits. But there's also something called net operating loss, which is when you're a business, usually you can only write off about 80% of your operating costs against your income. But because of COVID, there were times where you could write off 100%. But even better, you could mix and match. A year that was really profitable with a year that was high expenses, you can mix and match and get more write-off. Therefore, go back and reclaim money that's rightfully yours. So this tax framework is, once you understand, it's about the right team, it's about maximizing deductions, and then it's about how you classify your income or reclassify it. It lets you keep more of what you make without having to read the tax code, without having to know everything that's out there.
Here's the 2 tax traps that most people fall victim to. Number 1, deferring tax. Okay, my great-grandfather left Italy. He lived in San Giovanni in Fiore, and in 1913, he left Italy because he literally couldn't put food on the table. That's where the mob was really born, was down in that area, and they were taking a bunch of his profits, and the government was taking his profits, so he left his pregnant wife to be able to go to America and start earning money. It took him 7 years to leave the tent that he lived in and buy a home and become, of all things, a coal miner and bring his family out. Now, ironically, 1913 was the same year that the US created the revenue code, which was the IRS and taxing people. It was gonna be this temporary thing, by the way. It hasn't felt too temporary. But what if you defer your taxes into a future where taxes go up? Now, I can't tell you they're going to go up. I'm just telling you, in the US alone, there's $21 trillion of debt. And typically the government raises money by taxation, not by producing goods and services, right? So what if you defer taxes and you're more successful in the future? If anyone's told you you're going to be in a lower tax bracket in the future, don't listen to that. Why would you want to have less money in the future? Stop listening to everything Ryan's teaching you if you want to be broke in the future and have a lower tax, right? You're going to have more taxes in the future just because of inflation alone. You're going to have more money, and it's going to take more money to buy the same things that it takes to buy today, which means you're going to get hit with more taxes. So unless you're going to have more tax deductions, I mean, Mick Jagger just had a kid recently, so I guess he can write that off on his taxes. But most of us, when we're at that age, we're not having more kids. That's a confusing lineage, by the way, because the baby is a grandfather for someone that's 40 years older. I can't wrap my mind around it. But so I think this song's true. He can't get no satisfaction. You know what I'm saying? Mainly because kids 0 to 4 are romance and sleep terrorists. Let's just face it. That's part of their nature. Love them, but yeah. Okay, so let's talk about these 4 pieces. Deferring is a problem because you might be in a higher tax bracket, and spending just in the name of saving tax doesn't make sense either. Why would you ever want to spend $1 to save 37.5 cents? I tried it once. I mean, when I was early on in my life, I just got married. My wife had this little red Infiniti car that she loved. I'm like, babe, I got a great idea. We got this big tax bill coming. What we're going to do is we're going to buy an SUV. She's like, we don't have any kids we don't go to the mountains. You just work all the time. I was in the play to win methodology back then. I was like, yeah, but we're going to get to write it off through this obscure thing called Section 179 because it's over 5,500 pounds. And it's like an old farmer's rule that now we can write this off. And so we did. We bought a depreciating asset by writing it off that year and ended up spending $1 to save 37 cents. How genius was that? She didn't even want it. She was like, but isn't a car depreciated? I'm like, I'm the financial genius here, just listen, okay? I've learned to listen. So, don't just spend to save, and don't just defer. Instead, use these 4 things. So, how do we reclassify? The type of corporation you choose absolutely matters. If you're a single member LLC, you're probably overpaying on tax. Even having a 1% partner in there makes a difference. Choosing an S election makes a difference. An S election allows you to take a reasonable salary. Reasonable isn't what you're worth, it's what someone else would be paid. And take the rest in distributions, and distributions save you up to 15.3% of tax. I got a fan here that's completely agreeing with me. Sweet, you got some good people in the room. So yeah, the S election would allow you to do that, or an S corporation, right? Or if you have like a new product coming out that isn't going to be massive, or you want to launch things, a C corporation has lower tax on the first $50,000. So choosing that type of thing and classifying your income. Here's another example of reclassification. You all have intellectual property. Are you collapsing all your intellectual property in your one main company? Because you can separate it out into a different company and get paid in licensee fees or royalty fees and have less tax on it. That would be another example of reclassification. Or this isn't my normal clientele, but I have a rapper who's a client, really famous, and I made him go through the same channels everyone else did, and he came to one of our workshops, and he was complaining about how rappers, a lot of times, they're paying for a lot of their own video production and a lot of the clothes that they buy. And I'm not sure if they wear the clothes in their videos out to everyday life, but he doesn't, okay? So he's like, yeah, my accountant says I can't write that off. And when you look in the code, it says uniforms, if they can be worn in everyday life, can't be written off. But I go, how is it that Hollywood's writing all this off? Because Hollywood's buying stuff all the time that people could wear out every day. Well, the bottom line for Hollywood is they have production companies. So as soon as he set up a production company, he can now write off all those things when he buys it through there. That's reclassification. So reclassification is a game changer. So how do we take ordinary income, which is taxed higher than capital gains? Well, by owning a business, just by doing that, the equity you build in your business, if you ever sell a part or all of that, that's capital gains. That's going to lower your taxes. Let's say you're facing a ton of risk. You can set up your own insurance company, put money in pre-tax for that company, and then if you don't have the insurance claim, you get to take that out as a capital gain. So I just want you to wrap your head around the possibilities. Candidly, I'm going to make sure you have tons of resources, because I want you to make sure that you're not wasting money, that you keep a lot more of what you make. But I'm planting the seeds right now so you know what's possible, right? The third category was taxable to tax-free. There's a couple ways to do this. Let's say that you want to sell your business, but you're afraid to just sell it to anyone, because if you sell it out there in the world, they might not do it the same way you do it. They might not care about it the same way. We hear about this all the time. You can actually do what's called an ESOP, Employee Stock Option Program, where you could sell your business to your employees. The banks will even finance it for them on the purchase, and you don't pay tax on the stock that they buy, right? Or even better, let's say you have a charitable inclination and you have any highly appreciated asset like real estate or a business or a stock. You can donate it to what's called a charitable trust. Now, this blows my mind, because usually when you sell your business, you pay tax and you have what's left over. If you decide to use a charitable trust, you donate it to a charitable trust of a charity that you love. Then when it sells, you pay no tax. But when you donated it, they gave you a proportionate tax deduction. So you got a deduction and no tax, and then you can take income out of that trust for up to 5% of money that's in there, up to 50% depending on the performance, because you're the first one to benefit. The charity only keeps what's left over when you die. So I'll let that sink in for a second. I think giving to charity might be cooler than giving it to the IRS. So the last one is tax arbitrage. I'll just share one tax arbitrage strategy because they're a little bit more complicated, and I want you to be very careful if anyone ever tells you about them, because there are some that are legit and a lot that are not. Okay, so I got a little caveat there. Solar credits would be an example. Other examples could be film credits. Other examples could be easements. Like if you owned a property that had a bunch of land on it and you want to pass that on for generations to come, you can do what's called a conservation easement, where you say, we're never going to develop that property. We're going to preserve that land, and you get a major tax credit for that. Or let's say that you buy a historical building and you say, we're never going to tear it down, we love this historical building, you can donate the historical facade as an easement and get major tax deductions. I know we're getting in the weeds here a little bit, but you know who determines what that is the Forest Service of all things. Forest Service goes, yeah, we like that historical easement, let's give you this tax deduction. So like those are tax arbitrage. I'll just give you the simplest one that I've ever done. I bought a building years ago, and my attorney came through the building, and as he walked through, he goes, man, a lot of white walls here. Are you going to do anything? Put any pictures up on the walls? I'm like, can we just enjoy that I just finished the building? And he's like, no, I actually said it for a reason. You can actually buy artwork, and after you've owned the artwork for 3 years, you can donate it for the full appraised value, but you could buy it at a discount if you agree to never sell it on the open market. And I was like, tell me more. So he got me to one of these artists that I said, I'm going to buy a collection from you at a major discount, 25 cents on the dollar, because these are things that's hard for them to sell individually. I then demonstrate it in the building for 3 years, and then I donate it to museums after 3 years, and I get $2 back for every dollar I spent. That's tax arbitrage.
You're being lied to and manipulated. Headlines are used to jar up anger and other emotion that is fueling division and the intent to make money on your money, to separate you from your money without solving anything that's actually mentioned in these advertorials or ads or articles. Instead, they just make matters worse. So I got to share with you what I got in my inbox. It said, new privilege, and it was in quotations with privilege, tax will destroy the savings of anyone with over $10,000. Okay, so it said new, and then the next line said, Ronald Reagan warned about a greedy plan to destroy the savings of Americans. Here's how some patriots are fighting back. So first off, you can't use the word new and then immediately go to Ronald Reagan. That's not new. Okay, then it goes to this. It says, the total debt of the American government just surpassed a record $30 trillion. Yeah, that's alarming. I'm with them on that. Here's where they get pretty divisive. And they say, and the Democrats are preparing to pour fuel onto the fire with trillions, they say trillions, plural, more in social justice spending. They use quotations. First off, I want to let you know I don't really think of myself as a Republican or a Democrat. It seems that both sides are pretty damn into spending. They're into cronyism, where corporations fund them essentially and they do the bidding of those corporations. I do like how articulate President Obama was, or Ronald Reagan, extraordinarily articulate. That's great, right? I would definitely prefer that over the last two presidents. Anyway, back to the point. The ad goes on to say, the money is being wasted on people, and then in bold it says, who don't even like America. Okay, this sounds pretty racist to me here. Don't even like America, social justice, right? Then it says, meanwhile, normal hardworking people, so normal hardworking people are being victimized and seeing their buying power vanish because of runaway inflation. I agree. We have runaway inflation. It is harming the middle class, the lower middle class, and the poor, no doubt. But let's be clear. Most of this comes from private banks, by the way. The central banks, the Federal Reserve, which is neither federal nor reserve. And what they did was use quantitative easing, which was they printed and added a ton of money to the money supply. Now, definitely government spending is an issue, but not the main issue with runaway inflation. Then they go back to say, former President Ronald Reagan once warned, inflation is violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. Again, super articulate. And yeah, inflation is concerning. But now they say all liberals have to do is yell privilege. They put in quotation, caps, and bold, and they get trillions for their wasteful social justice programs. Okay, are they really getting trillions? Who's getting trillions? What proposal or plan is going to social justice warriors, for social justice programs? First off, I cannot stand cancel culture. I can't stand censorship and people telling you how to think. But at the same time, I can't stand seeing systematic poverty that is absolutely getting demolished because money's going into Wall Street fat cats' hands, going into banks instead of to everyone else. And I also don't like to just see money handed out for nothing, which happened during Trump and during Biden's time. So this is inflating a situation in division without merit, calling it privilege or social justice as if we're just wasting money going to people who are doing nothing. There is a lot of things that are going on that are bad for a lot of people. And to say that all of that is complete government waste is crazy. I think government is filled with bureaucracy. I think it's filled with fundraising that ends up in the wrong hands. I think there's a lot of things that are completely inefficient, but to say it's all bad and to blame it on so-called liberals, this is crazy, this ad. The question is, it says in the ad, will your savings be there when you need it? And will it last as long as you need it? And then it says, are there options to protect yourself? Yes, exclamation point, and then in all bold, there is one loophole you can use to protect your IRA or 401k. And then they put in parentheses, if you hurry, right? Gotta hurry, got this scarcity play, by the way. So what they tell you to do is move some of your money into gold now. Gold is the favorite thing that people like to use during times where there's fear and chaos. And a lot of people don't understand how volatile that market is, don't understand a lot about it. They just start shoveling their money towards it. But why? Because they're like, because our money system is being demolished. Well, there's definitely problems with quantitative easing, as I mentioned. We have massive inflation problems. But here's what their solution, they say. You can protect your savings from Biden's limitless money printing. It's not Biden's limitless money printing. It's the Federal Reserve, which is a private bank. It's centralized bankers. So this is completely misleading. And then he says Biden's limitless money is the inflation that it leads to. So again, is it Biden printing the money or the Federal Reserve? And were they printing money when Trump was in office? Yeah, so let's think about this a bit. And one of the best ways to buy gold is through a self-directed gold IRA. So here is the problem. IRAs are government-sponsored plans. So they're telling you to put it or keep it in a government-sponsored plan that defers your tax. Now, if they're saying that there's runaway spending with the government, trillions of dollars on things that you don't want it going to is what they're trying to imply here, well, guess what? Deferring tax in an IRA, you're going to have to pay that tax if it's a traditional IRA, a 401k, or any self-directed IRA that's non-Roth, 403b, or any of these kind of things. And so what they're trying to sell you on is to get a no-cost info kit on gold that they say explains everything you need to know to get started. Inside, you'll learn how the IRS tax law works and how to transfer your IRA or 401k as soon as today. By the way, this is why they said $10,000. They don't want to roll over your money if it's less than that. They say there's no taxes, fees, or penalties. This is absolutely not true. There's deferred taxes still. Yes, there's no tax on the rollover, but they're saying that government spending is a problem, taxes are going to go up. But to put your money into these plans, fuel it with gold, and gold's going to solve all your problems. If that goes up in value, you have to pay more taxes and you'll put more money in the government's hands, which they said not to do. So this is what's crazy about this ad. So don't trust the government. Put money in the government plan. Really? Again, if gold goes up in value, there would still be taxes owed on the plan, therefore funding more of the programs that these people are talking about. That's insane. I had to repeat it. It was so crazy to me. All right. And it says, but be warned. Time is running out. Okay. So make your decision now. Marketing, marketing, marketing. Fear and scarcity. Because as Democrats continue their woke money printing, it's not the Democrats that are printing, it's the Federal Reserve. The purchasing power of your savings is shrinking faster and faster. True, it is shrinking. Every minute you wait could mean hundreds of dollars lost due to inflation. I don't know. This is crazy to me. They say there are still some free info kits available that we can send today. By the way, there's not just some, there's unlimited. I guarantee, especially if it's digital, even if it's printed on paper. So it's just doing all of this marketing stuff, right? And this is last thing. Doesn't matter what wordisms the left uses to attack you. See, and all they've done is they know that they're targeting people that they think are Republican or have voted Republican or signed up. What happened is I signed up for some article or thing that was put out there, and then somehow I got put on this list, right? And at first I was like, how did I get on this? Then I tracked it back to who it was sent from. When it said Ben Shapiro, I was like, okay, what did I sign up there, right? They say you are privileged or racist. That's what they're saying. Or that you need to pay your fair share, but all these are smokescreens for how they really feel. This is what this article is saying. They simply want to steal from you. And printing vast sums of dollars out of nowhere is exactly how they're doing it. But this free info kit shows how just buy gold, put it in an IRA, get it now while you still can. So this is saying there could be a tax increase, yet it's about how to put gold inside of a tax-deferred plan. Self-directed IRA is still an IRA, still subject to the rules of the tax code that the government controls. So let's make a distinction. Federal Reserve and fractionalized banking combined with quantitative easing is the biggest and most huge problem with inflation. Higher inflation subjects to higher future taxes. Deferring taxes in a self-directed IRA means you have to pay taxes, which they're arguing are likely to go up. So maybe one solution is convert it to a Roth. I don't know, maybe that's what they're talking about, and pay the taxes today. But leaving it in a self-directed traditional deferred IRA is not a solution to a privilege tax. Again, 10K minimum was just about marketing and what's worth their time for rollover, and really has nothing to do with what's at risk. This is marketing, plain and simple. It's completely manipulative, garbage, and dividing our country unnecessarily. I think everyone would agree, let's not inefficiently hand money out or have it go in the wrong hands, which, by the way, happened with quantitative easing, primarily with banks and Wall Street. It's not like poor people were just getting all this money poured onto them for doing nothing. The people that needed it the most didn't get it. Yes, financial responsibility is the key to prosperity. Taking personal responsibility is the key. But we can look and understand that there's definitely haves and have-nots. There's definitely things inside of the system that happen with some of the biggest private banks in the world that never happen for someone who's born into poverty, that they never get a chance towards, and it would be nice. Wouldn't it be nice if we're all born equal, but then we have unequal opportunity based upon our level of willingness to add value, not unequal based upon which family we're born into or which government official that we know. So I get where they're triggering and they're trying to get people to get divided and upset and angry and blame each other. But can we just for a minute look at what we all agree upon, how we can connect with each other and not let this divisive marketing that actually still puts us in harm's way and never solves the problem? It's just someone trying to make money on a transaction by selling you gold or funds that are holding gold, and instead of actually giving you a real solution, it's time to look at each other and say, how can we add value? How can we serve others? How can we solve problems? How can we help? And instead of doing this garbage of trying to divide. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.